And a lot happened this week, actually.
Yeah.
What do you think was driving the markets? Because, boy, the stock market sure liked whatever they saw.
Well, I think there's still a sense out there that there's a reasonable probability of a soft landing, that the Fed maybe have to hike 1 or 2 more times max, but that's largely discounted now, and that everything is going to line up perfectly, a moderation in growth, but not too much, and a quick moderation in inflation that it would allow the Fed to ease significantly next year. I think that hope, and you get some data that supports it, some that doesn't, is what's really leading the stocks higher largely. Obviously, there's structural issues with AI and how that could help tech stocks in particular and ancillary businesses through new sources of revenue. But I think the macro picture is really these hopes for a soft landing, which I still personally think are premature.
So we're about halfway through the year now, exactly halfway through the year. Did you expect this is where we'd be when January 1 came around?
You know, the beginning of the year, we had the China reopening, and everyone was very excited about that. It happened faster. It was sort of a big bang reopening. I have been a little surprised with the degree of how quickly it's moderated. You know, the fact that we have youth unemployment in China at over 20%. Manufacturing in China is contracting outright now. Services is positive, but just barely. So China is going to need to do more stimulus. And we have the Politburo meeting coming up in July. I think if they do something, it'll be then. But if we don't see something bigger than the incremental steps they've taken so far, and something really aimed at the consumer, building consumer confidence, getting companies to bring people back to work, I think that one keeps moderating. I think the other thing that surprised me so far this year was the strength in tech. I mean, I think everyone's been surprised by the strength in tech. You've still had higher yields this year. You still had Fed hikes. And normally those longer duration assets are going to be more sensitive to that. But I think what's driven it regardless has been the very strong underlying consumer, because at the end of the day, there's still a big consumer and cyclical component to tech stocks. But in addition, again, these structural hopes around AI and what that's going to bring.
As you say, China right now seems to be disappointing, if anything, a bit. We'll see how it plays out the rest of the year. What's the knock-on effect of that, for example, in the United States? I mean, China has traditionally been the source of a lot of growth globally.
Yep.
It looks like it's not going to play that same role. What does that mean for the United States economy?
Well, it's so interesting. I think the U.S. could actually be a small net beneficiary when it comes to the stock market. So, again, think back to November, December, January, when we had the speculation and then actual reopening in China. You saw economies that are more sensitive to China, that have stronger trade relationships, business relationships, benefit even more than the U.S. did. So Germany, for example, 50% of their GDP is exports. China's a huge trade partner. Italy, a lot of the emerging Asian economies, commodity prices. So all the capital was going to these more cheaply valued, attractively valued stocks overseas that would benefit from China. Now with China sputtering and people saying, where do I want to allocate for the second half of the year, even though certain parts of the U.S. equity market could be seen very pricey, especially some of those tech names, the U.S. economy still looks more resilient than a lot of places overseas. So one thing that could be a surprise for the second half of the year is that the U.S. outperforms again. You know, it's amazing to say that with tech stocks valued where they are today, and I think that has to slow at some point soon, especially with the Fed continuing to raise rates. But if the U.S. is the best house on the block, and I think it will be in the second half of the year most likely, that might keep capital coming in here, which means a stronger dollar. And so certain U.S. stocks will benefit more than others.
We all pay so much attention to the central banks, not just the Fed, but the central banks. We heard from them this week at Sintra over in Portugal. And certainly we heard a message from Jay Powell from the Federal Reserve, from Christine Lagarde, and even from Mr. Bailey, Bank of England. If anything, indicated we're going to have higher for longer. How does that affect the market?
You know, I think that's really going to be end of the year and early next year's story. So again, right now the market is pricing in higher for longer for this year, especially compared to January. January, we're still thinking we could get rate cuts during this year. That's largely been removed, but we're still looking at a market discounting significant easing next year. Now, Jay Powell himself has said that for inflation to get back to 2%, their target, is probably not happening until 2025. So are they actually going to be easing a year ahead of that if inflation's above target? Maybe if there's a huge crisis or if the jobless claims and the payroll numbers deteriorate very materially. But if they don't, it's hard for me to see that easing coming. So I think that is going to be a headwind for equities in the U.S. and globally, probably as we get towards later in the year, and the Fed is signaling that we're not there yet.
As a recovering lawyer, I have to ask one quick one about the Supreme Court. We had several controversial decisions come down. Do they have any economic effect, do you think?
You know, the one decision that we got today about the student loan forgiveness, that's not going to go forward, you know, the decision itself is not as economically important, but there is a relative angle to this, which is that student loans have been forbeared, right? They haven't had to pay them since March 2020. And that ends this fall. The Bureau of Economic Analysis is saying 38 billion annual rate of disposable income they had from not paying those loans. That goes away. So I think when we think about what could hurt GDP at the end of the year, Q4, Q1, this could be a material hit for the consumer.